February 2026 CIECA webinar, Navigating the Sea of Insurance Trends in 2026. I'm Paul Berry, Executive Director for CIECA. The Collision Industry Electronic Commerce Association, or CIECA, develops and promotes electronic communication standards that allow the collision industry to be more efficient. We also provide webinars like this one to help educate both members and non-members on trends that impact systems, processes, and the exchange of data across the industry. Today's presenter is Patrick Sullivan, the editor of Auto Insurance Report, published by Risk Information. Pat began his career at Risk Information in 2007 as a journalist and analyst, before leaving in 2017 to work at InsurTech Carpe Data, and later at AIS. He returned to Risk Information as conference co-chairman and senior editor in 2021, and he speaks to insurance industry groups and leading insurance companies nationwide. As we start the webinar, I want to remind you that there is no verbal communication between the participants and the presenter. If you have questions during the webinar, please type them in the QA panel on the webinar screen. We will answer as many questions as possible at the end of the presentation. And now I'll turn the program over to Patrick Sullivan.
Thank you, Paul. Appreciate it. Well, I'm thrilled to talk to this group. I think it's going to be a really exciting time when they invited me to come do this. I jumped at the chance. I think CIECA is one of the only organizations I know of where you see shop people, you see insurance people, you see OEM people all coming together to work on various projects. And I think, the industry's kind of lacking that at the moment. So, talking to you guys and learning more about CIECA has always been fascinating, and excited to do it and talk about trends and a very dynamic time in our industry. So jumping right into it, the last couple of years have been interesting to say the least. I think pretty much everything that you could have happen, ups and downs, everything, carriers experienced the full gamut of emotions since 2020. And we're really entering a point now where, with the way rate increases have gone over the last 2 years, people finally reached profitability, recovered from some very tough years, and carriers are hungry for growth in 2026. They're looking to add premium, they're looking to add customers, and that's a market dynamic we haven't seen since pre-pandemic times. But at the same time that carriers are wanting to grow, there's some underlying trends that are really concerning to them that are causing some hesitation that they're trying to get in control of and figure out. And I think chief among them is really this issue of severity. It's been a thorn in their side, and it's something that is kind of lingering in the back of their minds. When you talk about auto severity, I think a lot of people jump to it's safety tech, it's ADAS, it's all of these things. I think although that plays a role, it's not exactly what's going on. ADAS is only in about a third of the fleet, which is a substantial number, but not enough to be the main driver of severity issues. You've also, at the same time that people talk about ADAS and safety, you have to recognize the way people are building cars. And Vision Zero has really been a defining thing for OEMs. They've been focused almost exclusively on saving lives, and I think very successfully so. But it's left them with a couple blind spots around auto severity. And the safety tech's not the only thing going into cars. As I was saying before, you have the infotainment centers, you have light bars, you have retracting mirrors. Funny story about that later. You have seat warmers. All of these things are leading to cars packed with more technology, more safety features, more features, period, that are increasingly expensive to repair. And all of the safety tech, all the accident avoidance stuff, all that complexity is not offsetting severity or frequency. The result of all of that is higher costs. So the average repair cost has almost doubled since 2008. I thought the stat from our friends at CCC was fascinating. The average repair cost in 2008 was $2,500. Now it's up to $4,768. That's as of the third quarter of 2025, which is the most recent data I can get my hands on. That's a huge jump. That's a fundamental change in what it takes to repair a car. And new tech just isn't offsetting its cost. I've also found, and I know this is not true of everyone on this call specifically. I know some of you care about repairability, and I don't mean to offend you, but most of the people at OEMs don't think about this. This is, there are things going back to the retractable mirror. So I was in downtown Chicago in a garage that looked very similar to something you'd find from a 70s political thriller. It was dingy and dark, and there were big steel columns, and The car next to me pulled out. The woman was staring at her backup mirror and or backup camera and sheared her side mirror clean off on the steel pillar. Just no amount of technology is going to fix that. It was thankfully an older car, so probably a couple $100 fix. But if that had cameras in it, if it had a retractable motor in it, if it was full of all of these features, it'd be thousands of dollars. It might be far more than her deductible, far more than the worth of the average premium she's paying. It's that type of thing that I think people aren't thinking about, of the weirder stuff that goes on. So we had Tricia Mora, who is the head of safety at General Motors, speak at our conference a number of years ago, and we asked her directly, like, do you think about repairability? And she was like, no, not really. I'm focused completely on safety. And I found that that's been true as I talked to more OEM people. I spoke at the Society of Automotive Engineers 2 weeks ago, did a lot of kind of the same things I'm talking about today. And that group was also like, oh yeah, we don't think about these kind of freaky, weird things, the kind of edge cases when it comes to repairability. They're focused on Vision Zero, and they're focused on making premium cars that sell. But the result of all that is that as you add complexity, as severity gets higher, it pushes insurance pricing up. So let's backtrack, because we'll kind of unpack all of that as I talk through all this to where the insurance industry has been in the last couple of years. So like I was saying, it's a roller coaster. You had premium returns in 2020 and 2021. For some reason, I can't quite remember, everybody stayed home for like 2 years and nobody was driving. So there were premium give backs. Then you had 2023 and 2022, which were the worst years in the history of auto insurance. So as the editor of Auto Insurance Report, we've been publishing since about 94. We are very much focused on trying to put together metrics and data from the NAIC and elsewhere about the performance of the industry. The furthest back we can go with solid data is into the 70s that you can compare it to. We were unable to find a year worse than 2022. If you look further back into the mist of time, the last time it was as bad as 22 is probably the first time someone mispriced a Model T. That's how bad that was. The result from carriers was to push rate really hard to try and get back to profitability, which they achieved in late 2024, about Q4, and were profitable throughout 25. Those who were not profitable at the end of 24 reached profitability sometime in 2025. So that has pushed them into a year where they're looking to grow. But let's talk a little bit about kind of the last couple of years and what happened, because I think it's instructive to the way carriers are going to behave this year. Also, I apologize for my boring slides. If you want to make me bigger, that might be more entertaining, but there's good data in here. So either way, this is loss ratio data from 2020 to 2025. Loss ratios, for those not plugged into all the acronyms of auto insurance, is claims paid divided by premiums collected. I think it's a great way to look at the performance of the auto business as far as how it's doing. So you see there in 2020 and 2021, loss ratios decline as vehicle miles travel fall, people stay inside. Then you have that surge to an industry worst 80.2% loss ratio. Gets a little better in 23 at 75.5, still catastrophic. Really starts to improve in 24. And the first 9 months of 2025, I apologize for that, you had a loss ratio of 60.9. That's the most recent data we can get out of the NAIC. So the market is dramatically improving over the last couple of years. So what went wrong, I think, is instructive. So you had frequency spike coming out of COVID. So during COVID, fewer people on the road, people were driving at much higher speeds. They were driving much worse than they had been traditionally. There was less enforcement, more distracted driving. All of that was going on. And when people started coming out of the COVID era and getting back on the roads, vehicle miles traveled increased, and you saw more traffic, people didn't change their driving behaviors. They kept driving at faster speeds. They kept being distracted. They kept ignoring, good, safe driving and crashing at a much higher rate than people expected, in a much more severe, not in terms of severity of how much it costs to repair a car, but in collision severity, how much energy is released when the two cars collide. They were bigger accidents. Big problem there. At the same time, you have this frequency incline going into a long rising severity trend. So severity was already high with spiked frequency. It really jumped in 2021 and has remained elevated ever since. And yes, there are COVID shortages, there were tech shortages, there were parts issues, but This is what carriers are keeping in the back of their minds. The severity trends have not changed since COVID. Frequency is moderated, although we'll talk about how much later on, but this was the worst case scenario. If you have this type of severity environment, what happens when severity rises? And it gets really catastrophic really quickly. And so that's the underlying thing that's keeping them up at night, trying to figure out how do we manage for that eventuality or that possibility. The response was coming out of all this was to push rate. And they pushed rate very aggressively, particularly in 2023. You can see there they took 16.9% in 23, but really tapered off in 25, only 0.5% from the top 10 carriers. And what I found really interesting is there's normally big fights when you're dealing with rate increases in the way the market's regulated between state regulators and carriers on what's the right level. How do you do this? It differs state to state. But by and large, even in California, regulators understood when you showed them the math of those loss ratio numbers, how much money was going out the door. They needed to raise rates. They needed to raise rates because they had to be able to pay claims and they had to have enough money to do so, particularly in an increased severity environment where, like I was saying before, frequency comes back up even a little bit. They need this extra profit to offset that. Rate changes weren't universal. So I was talking industry-wide, but I think it's important to look at companies specifically. So this is the top 10 carriers, 2020, 2025. And what you'll see is not everybody moved in a pack. Progressive, State Farm moved a little early. And those who could see trouble coming, those who could figure out something's afoot here. We're seeing frequency rises. We're seeing this new severity impacts. We're able to start making rate changes early. Thus, we're able to take their foot off the gas of rate changes earlier, get to profitability earlier, and start growing. So it's kind of been all over the place. But really what they developed and honed in the pandemic was kind of telematics-based and driving behavior-based, kind of early warning systems that have now become kind of standard as they look out and try and predict what's going forward. But really, those who figured out there's a problem and took action were able to be more successful last year and late year before. So I will give you some background. Market stabilized, frequency is declining through 2025, severity still elevated. We just got through peak profitability and growth. People loved that period. They were all sorts of record profits. This year, we're expecting a softer market and probably 2027 as well. Prices are probably going to fall a little bit. People are going to be trying to grow, mostly because carriers are confident in their rates. I think you can see that from the fact that they held flat last year with all the economic turmoil going on. They were like, no, we think we're in a good place. Let's try and grow. Competition's going to heat up. As a result, there's a couple things that they're worried about. They're going to not make as much money this year. If you see increased competition, that means they're changing prices. They're going to be competing in the marketplace. They will not hit the record profits they hit last year, and they're going to try and control for that. They're also not sure how long this is all going to last. As I was saying, they just saw what happens when you have a high frequency environment in this high severity environment, so they're nervous. And as a result, I think you're going to see them really trying to control every cost they can to manage that profitability changes. So they're going to try and control agents. They're going to try and control marketing spend. They're going to try and, well, maybe not marketing spend, but definitely agency, shops, parts and repair costs, bodily injury costs, internal things, efficiencies. That's the name of the game. Is if we're going to compete on price, where else can we save money to maintain as high level of profitability as we can? So I would expect a little more squeeze there. They might be fat and happy, but they're still worried. And if they're trying to compete more, they're looking for some places they can control. And then there's a whole list of things that keep them all up at night that I'm going to go through now. So last year I wrote a story in February, March, maybe it was April, about tariffs in the first half of the year. It was accurate for a week, and I was thrilled. I was so happy that the next issue of Auto Insurance Report came out, and my story was accurate for a couple more days, and then everything changed. But that uncertainty has caused major headaches for carriers. It complicates repair costs, it complicates parts costs, complicates all sorts of planning. But the uncertainty is how the moving pieces really make carriers go like, okay, what is actually happening? And so one of the things they've done is just kind of taking a step back. You've seen them kind of eat some of this increased costs. I think you've seen the same thing from OEMs. They're waiting to see how it shakes out. And they kind of view it as a one-time step change. They're going to have to adjust their pricing once they know what to do. Part of that is for the insurance people in the room, you'll know the answer to this. For everybody else, it's worth saying they can't preemptively raise rates to adjust to tariff increases. They have to wait till they have some actual historical data to show what those costs are. So I think that's still on the table. We'll see what happens with the USMCA or NAFTA 2 negotiations between Canada, Mexico, and the US on how that shakes out, but still a headache. Shopping trends, which is some consumer trends, has been elevated for a number of years during the pandemic, particularly during the price increases. Shopping for all groups was extremely high. Going into the end of 24 through early 25, the groups shopping the most were those with high credit-based insurance scores, so the best risks, if you will, were shopping like crazy and switching. So the best customers were the ones on the move. If you look at the data towards the end of last year, and there'll be a story in Auto Insurance Report in the next couple of weeks, kind of about early shopping trend data for this year. Everybody's still elevated. It's down slightly year over year, but it's still up in terms of the growth rate. I think that can change based on advertising, based on rates, based on how competitive people want to get, but worth knowing that customers are looking for a better deal. They want a better deal in large part because their rates just went up tremendously and they're trying to save some money. There's also economic headwinds on top of all this. So as I talk to economists, one of the things that worries me is all the uncertainty. What is happening with the jobs reports? What's happening with tariffs? What's happening with imports? That instability is leading people to make interesting choices. So deductibles have been going up. So $500 is the average deductible. That's been increasing. You're seeing more of a share move to the $1,000 deductible. People are trying to save money. That way you're seeing fewer claims. It's something I'm working on with the number of shops is trying to figure out this frequency issue. But you're seeing more out-of-pocket spend for repairs. You're seeing people not make claims because they don't want their rates to go up. They don't want to get non-renewed or canceled. It's driving a lot of behavior. And so there is this worry I think I have, and I know some of the people in the industry have about a masking of frequency, that people aren't getting in fewer accidents. They're not actually having fewer claims. It's not actually ADAS. It's really just an economic driver of, I don't want to make a claim. I can live with some damage on my car. I think you're starting to potentially see that unwind over this year, but it's definitely worth keeping an eye on how consumers deal with frequency and how they're going to change their policies around this economic stability. It's also good for competition. People are going to be hungry for a better deal. I do want to go back to ADAS and kind of pivot for a second here, because one of the things I think people talk about when they talk about frequency when they're missing this masking issue is, ADAS is in a lot of cars. That's got to be driving a reduction in claims and a reduction in frequency. And the best data I think available out there on kind of how this is going is from the Insurance Institute for Highway Safety. And this is a series of tests on various packages on cars model year 2017 and 2022 from IHS. And what they're finding is it's broadly a 33% reduction in claims for both physical damage, PD, and injury frequency, which is BI. For cars that are equipped. A lot of that's coming from AEB, the automatic emergency braking tech is very impactful, but ADAS at the moment providing about a 33% reduction. Most of that is in low severity claims. That's where it's really excelling is the small stuff. Now, I have a social science degree. I only took one stats class, and I believe some of the problems in the data you're seeing here come from something they tell me is means shifting. Because at the end of the day, you're eliminating a ton of low severity claims and you're seeing severity rise. And so it may be rising a little less than this chart suggests because of the mean shifting issue, but ultimately it's not offsetting the rise in severity costs. You're eliminating small stuff that keeps shops busy, that keeps those relationships between carriers and shops good and communication flowing. You're also eliminating things for carriers that are great customer service moments and moving towards more mid and high severity accidents. That's the bulk of what we're seeing. This is just for ADAS cars, though, cars equipped with those packages. So at the end of the day, a 1/3 decline in PD and BI frequency, mostly from low severity claims. A third of the fleet is outfitted with ADAS, a full ADAS package. And so carriers are seeing a 1/3 reduction on 1/3 of the fleet. And I think that's something to keep in mind of why isn't this making an impact on insurance pricing? It just hasn't penetrated enough of the fleet to make a difference when it comes to how pricing functions for auto insurance. There will be a snowball effect. As older cars come off the market, they're replaced with cars with the most advanced tech. You'll see more of that, but we're not there quite yet. I do want to talk about what cars people are buying, I think is important to look at. And largely what I've seen, and this is data from Cox Automotive and S&P Global Mobility, is people making under $150,000 are leaving the new car market. Really, people under 75,000 are getting out very quickly here. And all the growth has been in the higher income group. And so new cars are becoming largely a luxury product. That's really what's moving. And everybody else hasn't stopped buying cars, but they're buying cars off of first lease, used cars, 3-year-old cars, which, considering how cars are made today, they have much longer life expectancies. They're a much better product than what was on the road in the 80s or 90s or even the early 2000s. These things are going to last a while. And so buying a 3-year-old car is a different experience, and one that, you're still getting a good amount of tech and safety features on a car. But that's been a seismic change. And I think part of the driver is this cost piece. And it's not just we put ADAS in the car and now it's more expensive. It's all the additional features. It's the seat warmer. There's a thing like, you open a door and there's a light under the car that shows the manufacturer's logo, that type of stuff. So cars today, the highest average cost it's ever been, about an average of $50,000. That's a lot of money. You can get a down payment on a house for that much, at least here in Chicago. As for what people are specifically buying, they're moving away from sedans and more towards SUVs and trucks. So the old regular car that many of us grew up with, that's kind of on the outs. The biggest winner, though, is the compact SUV, which oddly is not that much bigger than an old car, but it's higher up. It weighs more. It's got more power. It is a different vehicle, but that's largely being pushed by millennial women. That's who's buying that car. That's who's driving that marketplace. And when you look at all the different vehicle types on the road today, compact SUVs is the one that is growing the fastest and is the most meaningful share of the marketplace. At the same time, I want to go back to talking about kind of the severity of the accident specifically. So we're buying fewer sedans and compact cars. We're buying heavier cars with turbocharged engines, cars with a lot of mass to them. And when they get in an accident at the same speed as a sedan, the accident's way more severe. It's just more energy coming out of these two cars as they collide. I was just at the Insurance Institute for Highway Safety, saw an amazing crash test of an SUV, and a wheel came off, the lights went everywhere. I mean, I tried to take home a headlamp fixture with me, but it didn't fit in my bag. But, I think it was like 30 miles per hour, and it devastated the vehicle in a way that it would devastate a sedan separately. And so that's a piece of this as well, as we're buying cars that when they collide, the accident is more complicated and more severe. And severity is really driving losses. So I want to kind of get into the severity thing more specifically. So as I was saying before, we've seen it almost double since 2008. And the biggest spike in severity came in 2020 and 2021. You saw a 10.2% increase in the cost of claims, and it did not go back down. Costs have kind of plateaued. I think this is one of the things that's been interesting is you see a spike during the COVID era, which is attributed to all the COVID factors, but once those get sorted out, it doesn't come down. It just remains there. And I think people are not feeling it as much in their pocketbooks because it's been offset by higher rates. And by people, I mean insurance companies and shops and vendors. You push that rate increase, kind of helps you manage the severity stuff. But there's another risk here that I think is worth talking about when it comes to what's driving severity, which is, for the most part, we talk about accidents, two cars hitting each other, somebody running into something, but comprehensive coverage, which deals with climate risk, which deals with vandalism, which deals with all the weirder stuff, plays a role here as well. The other newsletter I write for is Property Insurance Report. So I'm looking at the homeowners market. We look at a lot of climate risk. Every region has its own unique climate issue. My favorite story here is, Hurricane Ida hit Louisiana, very devastating. Then it flowed through the country, flooded out Philadelphia, caused massive flooding in New Jersey. Ton of auto insurance claims came out of that storm that people wouldn't have otherwise expected. John Sterling, the announcer for the New York Yankees, former announcer of the New York Yankees, had to get rescued out of his car during the storm because it flooded in a little gulch. Glad he was okay. But that's the type of thing I think you have to think about is you can't tech or ADAS your way out of a hailstorm or a falling tree. And as climate risk grows nationally, it's going to affect auto insurance as well as homeowners insurance. And that's driving losses as well. If you have a bunch of hailstones decimate a windshield and that costs $3,000 to repair as opposed to $200, it changes the calculus. All right, let's talk about total losses. They're up substantially over the last decade. We're at the highest rate we've ever seen, according to our friends at CCC, about 22.8% of claims or total losses, up over the last couple of years. And this is happening at a time when used car prices are rising, which normally sets a decline in total loss rates as those cars become worth more as used or salvaged vehicles. So what's happened here is it's not so much new cars driving this, but the aging fleet. So the average age of a vehicle today is about 12.8 years old, just about 13 years, give or take. Those cars, when they get in an accident, are pretty much totaled out. You also have more mean shifting going on here. The decline in low dollar claims means you're eliminating a lot of those, leading to just more high severity claims, more total losses. So that's happening. And when I talk to shops, when I talk to people in the repair industry, one of the things I'm hearing is that all the advanced electronics in cars, all of the complexity within a vehicle is totaling out cars faster. You need less damage for a total loss than you did historically. So that's really pushing things. There's also a number of downstream impacts I think are important to talk about. Once again, it's not just ADAS adoption. When I talk to shops about this issue, it's wiring, it's cameras, it's sensors, it's all those pieces we talk about. Mega casting complicates repair. Now you have to repair a whole chunk of the car, which might be great for manufacturing, but harder for repair. Calibration costs, which we'll get to in a little bit. That's kind of driving it and driving total losses to happen later in the process. Talking to a repair shop who was like, okay, a car comes in, it looks fine, but I start taking it apart. I start getting into the vehicle itself, which is very dense. Like you can't pop up a hood and see all possible damage. And I find there's a crack in the frame, and now it's a total loss, even though it took me 3 days to get there. And we told them they could repair it. We could repair it. We had an estimate. Big headache. Sensor placement, I think, is a big component of this. When I was at the SIE, I was talking to some people, and they had a session where a lot of pickup trucks are too tall to see children. This is a problem with pedestrian fatalities. And one of the solutions proposed was, let's just add more sensors to the bumper or undercarriage to detect small children. Except that's a very vulnerable part of the car. So if you pat $10,000 worth of gear into a bumper that's supposed to be a sacrificial part of the car, going to raise costs, going to be an issue. The explosion in trim packages, another piece of all this puzzle. You need more parts hanging out. Speaking specifically about parts, where I see the numbers really matter when it comes to proving out all of what I've just said, that here's why I'm right. The average parts per claim has gone up dramatically over the last couple of years, from 8.9 parts per claim in 2013 up to about 13 parts in 2025. It's a big increase. Labor hours, these cars are far more complicated to repair. They take longer. You can see it going up from 23 in 2013 to 26 hours. Labor rates also going up commensurate with training costs. Someone was telling me an estimated cost for how much it takes to get a tech certified these days, and I was shocked at the price tag on keeping someone's certification up. And there's still a shortage of techs driving up rates. We're still not producing enough of them through the current education system, but I'll get to that in a minute. I want to talk to some of the things that complexity is doing to insurance carriers specifically. So photo estimating was all the rage about 10 years ago. We can use our fancy phones and cameras and iPads and whatever to take photos of the car. We can do a lot of desk adjusting. It's going to be great. We can use AI tech to kind of determine that by a computer, and it'll streamline the whole process. And as cars have gotten more complicated, as there's more stuff in them, as they're denser, it's become less effective. And so that's been a challenge for carriers. They were really into this photo estimating thing. They put a lot of time and energy into it, and changes in the way cars are manufactured have made it less effective than everyone hoped. Supplements is also something that's been impacted by all this. For a long time, they were viewed as mistakes in the initial estimate. Increasingly, we're getting updates. More than half of claims these days have some sort of supplement on them. A lot of calibrations end up in supplements. And I think carriers are starting to realize they need to treat supplements as something they need to respond to quickly. It's part of the competitive landscape. If I'm really good at handling supplements, I'm going to have a better claim experience with my customer, with the shop. I think that's a development here they're trying to wrap their heads around. Calibration remains a major headache. It's expensive, about $500 per car. Requires a lot of specialized tech, OEM to OEM. Having just complained about it, expensive, it's critical. These systems, all the 8S stuff, all the tech stuff doesn't work if it's not calibrated appropriately. If a camera's off by 1 degree, all of a sudden the AB thing stops working. So I think over time, calibration is going to become essential to repair and the maintenance of a vehicle. I want to talk a little bit about the shop landscape specifically for a minute. That's really changed for the last couple of years, and all of this is impacting it. Coming out of the pandemic, you saw a lot of shop consolidation as owners of independent shops went, all right, that's enough change for me. I'm out. I'm going to take my money and run. And so a lot of the DRP networks have scooped up, made a lot of growth for those guys, for Caliber, Gerber, Crash Champions, very successful in that space. At the same time, they and independent shops have realized specialization and certification is the key. All of that tech requires someone who's really well educated to fix it. And every car is a little different. The procedures are different. The equipment required to fix them is different. And so what I've seen from independent shops is I'm going to be the best Mercedes shop in the city. If you have a Mercedes that gets in an accident, you send it to me because I'm the best. At the DRP level, what I'm seeing is instead of I have a bunch of generalist shops and all comers, I have my Ford shop, I have my GM shop. Over here, I've got a Toyota shop, Hyundai shop over here. I have a calibration center over here. I've got, Volvo. They're starting to diversify their holdings by manufacturer in order to offset the cost required to fix all of these cars. I think the days of a generalist shop are kind of numbered. I could be wrong, but I've been wrong before a couple of times. But I think generally, the shop needs to be specialized. The infrastructure costs alone are going to force that. The need to go from, we haven't talked about EVs at all in this presentation, but that's something I'm seeing in the shop world. Most shops have like a 2-post lift. Two holes in the ground, goes up. You can do most ICE vehicles, internal combustion vehicles in that fashion. EVs are heavier. They're beefier cars. They need a 4-post lift, and that's an expensive chain. Not to mention, you need the safety tech because of its electricity. You need charging stations and keep the car operating. That's a substantial investment. The industry's been here before. If you look at aluminum, is a good example of that, but that's a big change here. Going back to people getting out of the industry, a lot of very skilled techs left the industry during the pandemic, so we have lingering shortages. I know a lot of the shop guys, a lot of insurance companies. I'm seeing this from OEMs as well, people working together to increase the number of techs out there, but they need a lot of training. This is not just a high school diploma. You need essentially a college level degree in fixing cars. It's a different beast. It's very specialized. It's going to cost a lot more because you need more of a person to do that. Okay, speaking of more stuff, let's pivot. If you can't tell by all the various things behind me, I'm a bit of a Luddite. So let's talk about autonomous vehicles. A number of years ago, we had Anthony Lewandowski, who's the founder of Waymo, present at our auto meeting. He came down and presented in orange sneakers, wrinkled up khakis, and it looked like he just got out of bed. But all the work we did with him, I found him brilliant. I was blown away by his intellect, by what he was able to do at Waymo. His senior thesis was a DARPA challenge to make an autonomous vehicle drive from Berkeley to Governor's Island I think it's Governor's Island, an island in the Bay of San Francisco, which he thought was too easy. So instead of making a car do it, he made a motorcycle do it. The guy was smart. And when he spoke to our group, he was like, autonomous vehicles are 10 to 15 years away. And this was in 2013, before his legal troubles. You can Google him if you would like to know more. But anyway, 13 years later, it still feels like we're 10 to 15 years away. This is very slow. And yes, you have Waymo robotaxis, you have Tesla stuff, you have Super Cruise, you have all these things, but robotaxi deployment's in its infancy. It's in specific cities, even within the Bay Area, only specific municipalities is this operating, and they're commercial vehicles. I mean, Waymo is full of all sorts of specialized tech. I just don't see it becoming a personal vehicle anytime soon. And I think more than that, there's a big cultural and regulatory barrier to overcome here. I mean, they called the BMW the ultimate driving machine, not the ultimate riding machine. I mean, people write songs about how much they love to drive. It's a big part of American post-war culture, this freedom of the automobile. I think taking the steering wheel out of the hands of Americans is going to take time. It's not going to happen overnight, not going to happen quickly, that's for sure. And I think there are regulatory questions unanswered. Who's going to manage this? Is Waymo just going to take over the roads? How will they compete with a Tesla product, with a GM product, with a Ford product, with a Toyota product? Like, how is that going to operate? And we haven't figured that out yet. There's also challenges around, product liability and commercial policies and commercial legal issues. It's going to be a while. They're not coming soon to change everything. That said, the truth of what they actually are doing is very impactful. You're seeing slow incremental improvements across the fleet as the tech being designed by Waymo and by GM and by others moves down into the fleet. Now, that's the truth, and it's not very sexy. Incremental improvement is not something Wall Street likes to hear. It's not something Silicon Valley likes to hear, but it's the impactful thing. We're slowly marching there. It is an inevitability. Current systems, though, still some room to grow. ADAS currently tops out at about 30 miles per hour based on testing. It is getting pushed to higher speeds. The new test from IHS on hands-free driving is moving up to 31, 37, and 43 miles per hour. If they're funky, it's because it's supposed to be in kilometers, but we're in the United States. We use miles per hour for whatever reason. There's also technology questions. So at the moment, most systems are camera and radar. Is that going to be enough? Is that the system? Or is it like LiDAR? Do you need to put that on cars? The Waymos are using LiDAR. Most production vehicles, personal production vehicles today, use the radar camera set. That's also what Tesla believes is all you need to do it. See if that's true. The Volvo EX90 has had a very nice LiDAR unit on it. We had Luminar before their financial troubles come speak at our conference last year. And I was very impressed with the LiDAR tech. It feels like it answers a lot of questions left by the radar camera thing. But a lot of the tests at IHS are showing is that radar and camera has a ton of room to grow and improve on a software basis. So work to be done there. And like I was saying, courts need to address this as well. How are we going to manage lawsuits and responsibility around autonomy? So I think there's a long road ahead on the autonomous front. The ADAS stuff is great at low-cost claims and avoiding, I talked a lot about low-cost claims, but it does a great job at avoiding catastrophic accidents. It is actively saving lives, but all of the safety tech struggles with the weird stuff. The weird garage where I'm supposed to meet an informant where someone shears their side mirror off is a problem. It struggles with hailstorms. Most accidents are not something you predict. It's something strange. Bumpers and stuff need to get damaged. And when I was at SAE and talking to people, I had this little slide after that, the stuff that's driving losses typically is not impacting Vision Zero. And so it's not thought about by engineers because they're focused on saving lives. But I think things that impact claims costs are something OEMs need to start thinking about if they want to make an impact on the insurance costs. To go back to my bumpers example, if you have a sacrificial part of the car, it should be sacrificed. I was talking to a carrier who was bemoaning to me, I just want a $500 bumper. Why can't a bumper be $500? That'd be so nice. And I think that ship has sailed long ago. But they called me months later. They did some work. They were looking at parts costs. And they asked me, I think, a very intelligent question was, is anyone basing their labor rates and their shop rates on OEM specifically? So if an OEM's bumper costs $3,000 and another one costs $5,000, is anybody taking that into account to set labor, to set average cost rates, to adjust how much they're paying? I think that's an interesting idea. Got to follow up with that carrier, but you have to think about that, the crumple zone and everything else. It's generated a lot of safety, but if it's going to total a car out, is that the best idea? So my little OEM spiel here is if they want to drive down the total cost of ownership, which they all say they do, they should start thinking about repair and auto design. Safety is important, but irrelevant if no one can get in the car and no one can afford it. I think the solution there is looking towards standardization and accepting some level of right to repair. I'm not saying go crazy, but I'm saying we need to figure out a way that everyone can work together to make repairing cars easier. So going back to the X90, the sensor was on the roof of the car. A lot of the time, sensor placement is about aesthetics and about effectiveness. The X90, there was a long discussion of Volvo and Luminar about where to put the sensor. It ended up on top, in part because that was a great place for the LiDAR unit to see it, but because if it was damaged, you could swap it in and out without doing body work, without having to recalibrate things, without changing the windshield. It avoided a lot of the repair cost pieces. I think it's worth thinking about. There's also this other crazy idea I've got here where, and we're talking to some people from NHTSA, former NHTSA regulators about this. All the tech in cars, how long will it last? Will we have this kind of Y2K moment where all of a sudden, like our iPhones or any computer using Windows 9, they just can't be updated anymore? How long are manufacturers responsible for software upkeep? I think that's a new question. You look back to older cars, like a 1964 Shelby Cobra, it's a machine. As long as you keep the parts in good working order, it still runs. Manufacturers need to maintain software is a new piece of this I think needs to get sorted out. All right, so as far as what to do here, my little like, if I was you, here's what I would do. And so it's fortuitous I'm talking to CIECA, a standards organization. Maybe try standards, that could help. Just a thought. But I think not just on one thing, thinking about parts. So going back to my little Y2K thing, camera pieces. Is there a way to have a dongle to make it so that you don't need model year specific or even 5-year parts, but you can have a camera from anywhere in the last 15 years that plugs in, making that car last longer? Figuring out calibration procedures, figuring out calibration software to have some generic stuff that anyone can use to bring down the cost. So I don't need 6 systems to calibrate any car that comes into my shop, but I can calibrate 6 things based on one system. Safety procedures is something we were talking to a shop guy who I think might be on this call about safety procedures and specifically taking out the steering column to check on a chip to make sure it's calibrated, which is not a small task and not an inexpensive task. And what he was telling us is that 25% of the time there's an issue. The other 75% of the time there's no issue. And yes, it is safer to check every single time. And not doing so leads you to things like the John Eagle decision from Texas a number of years ago, where there was a non-OEM approved repair methodology on a body. The welds weren't right, and when a car got in an accident, people died. So yes, you need to make sure your safety procedures are up to par, but figuring out, okay, how do we make it so that when this car comes into a shop and we need to do safety procedures, we're doing the right ones in an effective way and not driving up costs too much. That type of work, I think, needs to happen and is not currently happening. But to do that, OEMs and insurers would need to interact more. You would need claims data, you would need safety data, you would need shop information, all flowing. And what I found is that at a senior level, so executive levels, there's no real relationship between OEMs and insurance companies. And I can say that because when we go and talk to boards of directors, when I talk to senior leadership at insurance companies, which I do quite a bit, that's part of what we do at Risk Information, they don't have a relationship. Now, I think other people do within the company, specifically the claims department, but like the head of claims doesn't have someone they can call at Ford or Toyota or Tesla. The CEO of Allstate doesn't have a contact at the OEMs. I think if you're going to make requirements and set standards around parts, around calibration, around safety procedures, around manufacturing, around repair, you need to do it at a senior level to figure out, okay, what's the best thing to do to maximize both safety and cost effectiveness to bring down the total cost of ownership? I think there's a lot of work to be done there. It's challenging because I don't think, it's not that these groups are doing something wrong. They haven't needed to have a relationship like this in the past. With the way cars are behaving today, they kind of do. So to wrap it up, and amazingly I'm on time, I'm shocking myself there. Insurance companies are under less pressure this year, but the underlying issues are still there. They're still worried about frequency issues, pushing up losses. And so you're going to see the market heat up. You might see carrier discipline wane on pricing and on other pieces, but I think they're all going to look to manage costs across the board in 2026. They're going to look to grow and find a way to minimize the loss in profitability from reducing rates and from trying to grow more. And with that, I'm all done. I think we have time for some questions here, but thank you all for your time. That was really fun to do. And I hope I didn't look too weird sitting here in my room by myself speaking in a camera.
No,
So,
Patrick, thank you
huh?
very much. Great information. Stacy Phillips is CIECA's marketing director, and she's been monitoring the questions panel. Stacy, do we have any questions for Patrick?
Yes, thank you, Pat, for sharing great information. One of our attendees mentioned about ADAS, and when you say that ADAS is only on about 1/3 of the total US fleet car park, have you factored in that most of the older repair park, which is less likely to feature ADAS, is generally less likely to be repairable, simply due to reduced vehicle value? If you have, do you know the percentage of ADAS features in the model years of vehicles that should be repairable? And she mentions ADAS percentage on the repairable fleet should be much higher than 33%.
So that is knowable. I do not currently know it. I know that, and I'd have to go back and find my numbers on there. Some of the interesting things to look at there would be the total loss rates. So, like, I think cars like 10 years or older, I think make up 70% or 70% of those are total losses. I have to go check. As far as the repairable fleet, that is work that can be done. I have not seen anyone do it. But I imagine Mitchell or CCC could do something like that, or one of the DRP networks who has enough volume. Good question. I'm going to write that down and work on that. If you email me after
Thank you.
this, yeah.
Thank you. And how do you suggest our attendees stay up with what's coming in the future? There's so many changes in different areas.
So I think there's a number of bodies. I think you look at CIECA, you look at IHS, you look at the thought leadership coming out of the estimating platforms. I think that's a great way to go about it. Staying in touch with the manufacturers themselves, seeing what they're putting out is worth doing. On the training front, the Society of Collision Engineering, I think is a good place to go there. It's also Tech Force. And then I like Crash Network. John Yoswick's newsletters is good. I read that pretty frequently. And then in our pages, we try and cover this as well. So I think you just got to look at a breadth of it. Part of the challenge is there's a lot of moving pieces here. It's going to take a pretty broad range of sources to keep you up on everything.
Thank you. We don't have any other
I did
questions
see,
at this time. Let's see something in the
I saw
chat.
one in the chat that was good.
Look,
Somebody
great
talked about
presentation.
generalization versus specialization, and the specialization working better in cities, not necessarily in rural places or lower population areas. I think that is a spot on piece, which is, I think, one of the reasons you need to see more standardization and the ability to bring costs down for retrofitting and for repairability. That kind of like repair thing I was talking about of, all right, how do we get it calibration systems from like 8 to fewer than that? I think that hits on that. Like, you can't have 17 shops, one for each OEM in like Kearney, Nebraska, where my wife is from. You do need some generalist shops, but you can't make it cost prohibitive for them to stay in business. So I think that is a main issue that needs to be addressed. One of the challenges there is I know a lot of you have the dealership network on top of that. They do a lot of repair work as well. And I know OEMs try and drive business to their dealerships. So,
Thank you.
there you go.
Thank you. We have a couple of more. Great information and thank you. You talked about repairs and claim frequency accidents as two different trend lines. Where are we now versus 2025, and what is your prediction for the future?
So is that what's my prediction on accident frequency in 2025?
I believe so.
So it's tough to say, but one of the things that I have seen, and this is something that the reason it's tough to say is I'm actively working on a project to figure that out, to kind of make some projections that is in line for our spring auto conference in April. But what I've been seeing is if you look at some historical data around claims frequency and rate increases, and this is data going back to about 2000, every time there's a big rate increase, frequency tends to fall, frequency reporting tends to fall. And once rates stabilize, frequency starts to creep back up. So the question for me is, I think frequency is going to creep up this year as people make more claims. If everything stays as is, probably mid-year, late this year, depending on the marketplace. But the economic uncertainty and potential for recessions and the tariff questions kind of throw a wrench in that, in terms of there are ways that could get undermined if you're in an environment where people are very nervous about the financial position, they might not be making as many claims, even if you have a very competitive auto insurance marketplace. But all things being equal, I think you're going to see frequency increase as people go back to shops to get things repaired. One of the things I'm trying to figure out is also the repairability, the repair data and the accident frequency data, because a lot of them look at claims volume, and I'm working with a number of shops to try and figure out repair volume as a differentiator, because they're seeing more out-of-pocket spend, and actually now people are launching financial service products at the shop level to help people pay for repairs, typically between $2,000 and $5,000. So I think that's a trend to keep an eye on, is the repair frequency, how many repairs are getting done in a shop, and claims frequency. And right now we're trying to work to figure out what's the delta on those.
Great, thanks. And our next question, what is your opinion on vehicle manufacturers opening their own collision repair shops, allowing the specialization you referenced as likely being needed in the future?
I think to a degree that already exists with dealerships. Your local dealership tends to have a shop. And I know Tesla's big at driving business there, but anti-steering laws, I think, make it hard to say you have to go, well, make it impossible to say you have to go to this shop. I think manufacturers will want to do that, but I think, it'll be tough. Part of this is the changing relationship between the OEM, the insurance company, and the driver and the shop. For a long time, the relationship on repairs between the shop and the insurance company. They're the ones figuring this out. And with increased complexity and repair requirements and procedure requirements, the OEM is joining that party. And so now you have these three people kind of in the mix here, trying to figure that out. I don't foresee OEMs just dominating that outright. I think independent shops have too much to value. You have the repair networks are too large. It'd be a big lift to do.
Thank you. Our next question, AEB was legislated here in Australia in March 2025, and we are yet to see the repair industry acknowledge the implications of not repairing ADAS systems that are fundamental. How do you see mandatory AEB in 2029 having an effect on repairs in the US?
Well, not repairing AEB is scary. That's a crazy idea. So I think about some work we did on the calibration side. So this is kind of a sideways answer to the question. If you don't repair the AEB systems correctly, if you don't calibrate them correctly, they don't behave. And people quickly get reliant upon them or expect them to be there. And when they stop working, people are going to get in accidents because they didn't hear the lane assist beep, and they're going to turn. This is something we're exploring. This is completely hypothetical. Are you going to see mandates around calibration and ADAS effectiveness in the same way you see smog tests, where you got to go in to a center and they do the smog test and they make sure your ADAS systems are up to par and are functioning? But yeah, you got to fix that. That's important. And I think as you can see with backup cameras and other requirements in the US, yeah, it's going to be mandated, whether it's at the state level or federal level.
Great, thank you. And what are your thoughts about OEM insurance?
I think it plays a role. So it's not new. You had GMAC insurance for a long time. We've kept in touch with what's going on at Toyota, what's going on at OnStar, deeply involved in what was going on at Tesla for a while. It's kind of a loss leader for them. For them, it's about total cost of ownership, and it's about brand loyalty and keeping people engaged. It's not going to take over everything because insurance is not just auto insurance. You have renters, you have homeowners, you have life, you have all sorts of other pieces of this equation that the OEMs are not going to get involved in. So I think OEM insurance plays a role. It's an important piece of this thing, but the broader challenge of embedded insurance. I find embedded insurance is challenging because you can't, and this has been pretty well proven where people have tried it, you can't embed a more complicated procedure into a sale. Selling a car is already complicated. Shoving a complicated insurance sale in there as well, I struggle with because I don't think people at the dealership want to squander a sales opportunity to sell that car because the insurance fell through. I think you want to give it as an option, which means you either go the route of we have our own thing, like what Tesla has, as I said, loss leader, brand piece, cost of ownership piece, or you move in the direction of an MGA or a digital agency where you're able to offer various companies. So there's a number of ways to go about it, but it's kind of like a new distribution channel in my mind. Hey, we can offer insurance here, but it's not going to be the predominant way insurance is sold.
Excellent. Well, thank you. We don't have any other questions.
Okay, well, thank you, Patrick. Great information, very informative.
Thank
Before
you.
we wrap up, I just want to say this presentation has been recorded and will be available later today at CIECA.com. I invite you to check CIECA.com for a schedule of future broadcasts and to watch recordings of past webinars. Links are available under the Meetings and Events tab. And finally, please follow CIECA's social media platforms to stay up to date on upcoming CIECA events and news. And Patrick, that concludes today's webinar. Thank you very much.
Thank you all. That was fun. Thanks.
Bye-bye.